Hi, Joaquin. How are you?
Hey, Chris, how's it going?
Very good. Last time we spoke was before the holidays. It's been a little while. Lots have happened in the markets. Obviously, the topic du jour is tariffs. A lot of things are going on, a lot of threats here and there. But before we start this conversation, I wanted to play you a clip from a famous movie and get your feedback on
1930,
it.
the
Sounds
Republican-controlled
good.
House of Representatives, in an effort to alleviate the effects of the anyone, the Great Depression, passed the anyone, a tariff bill, the Hawley-Smoot Tariff Act, which anyone raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone? Anyone know the effects? It did not work, and the United States sank deeper into the Great Depression. Today, we have a similar debate over this.
Well, anyway, that's a great setup for our conversation, isn't it?
Absolutely. I haven't watched Ferris Bueller's Day Out in a while.
So I thought that I had read that in the news that they had talked about that. So,
Yeah.
okay. So, over the last couple of weeks, we've had the threat from President Trump, and I'll break it down into kind of three categories or countries. Basically, you've got Canada and Mexico, where the threat of 25% tariffs, it went to the last minute. There's a reprieve, a 30-day reprieve. There's supposed to be some type of negotiation going on, but I mean, at the end of the day, there's still a probability or a high probability that we're going to get some type of tariff, and we'll see. China, it's effective next week, 10% tariff on China. China's retaliated with 15% on certain products. And then the European Union, we're not 100% sure what's going on that side. We just came out with a report, actually very timely, on earlier this week on tariffs. And so I thought what's important about this, and a lot of clients have been talking about one thing. They've been talking about potential inflation that would come out of all of these tariffs. And I think it's fitting and important to go beyond just the actual percentage and the potential effect of a tariff across different countries. In fact, in this report, what we've done is we've looked at second round effects. So potentially the effects from the dollar, potentially the effects from economic slowdown globally, and so on. And so why don't we start with that and get right to it and kind of talk a little bit about our report, what we got out of it, and why maybe some of the potential outcomes are different than what markets are really talking about right now.
Yeah. So when the president won in November, one of the sort of most noticeable market implications of that was an increase in inflation expectations, which explained a sizable portion of the rise in yields that we've seen since the Fed cut in September. And that, to a large extent, is tied to uncertainty around the possibility of protectionism, right? And the sort of most basic way of thinking about this is that a tariff is essentially, it acts similarly than a VAT tax would, whereby you're increasing the price of, in this case, imported goods that could affect directly inflation, right? Basically, you're raising the price level on consumer goods and potentially intermediate and capital goods. And there is a fear that that could sort of trigger an inflationary bout and potentially alter the Fed's decision making. And so the direct effect of a tariff, and again, it's a one-off impact on the price level, whether or not it's inflationary, if you forget about all these second round effects you talked about, depends on whether that affects inflation expectations, basically, right? If it doesn't, all you get is a one-off price increase. If it does affect inflation expectations, then it could have a more persistent impact. But basically, the channel of transmission, the standard one, would depend on the import share of spending. So how much consumers and businesses rely on imports. In the US specifically, the import share for consumer goods is quite low. It's less than 8% of the consumer basket, in part because the consumer basket itself is very tilted towards services. But unlike the 2018 experience, so China specifically primarily exports consumer goods to the US, so like electronics, for example, or apparel. Canada and Mexico don't. They primarily import either intermediate or capital goods to the US. And this sort of raises an additional layer of complexity, because while the US doesn't import a sizable portion of its consumer goods, so directly affecting the consumer basket, it does rely quite heavily on imports for sort of manufacturing processes. So if you look at the import share of spending by manufacturers in intermediate and capital goods, it's like 25% of spending, right? And so there is a direct impact that would basically depend on the import share of consumption and how much Canada, Mexico, and China make up of that basket. And then potentially sort of a cost push effect whereby producers decide to, facing higher input costs, depending on the strength of the economy and the amount of competition that they face, may decide to pass on those cost increases further onto consumers. So what we basically find is that the combination of those two factors would raise inflation up to 0.8, 0.9% at the peak. And this is absent any other shock, right? So, and of that, about 2/3 of that is the direct impact on CPI. And then there's the amplified impact from this cost push effect that I was describing on producer prices, and also by the fact that domestic producers face less competition all of a sudden, right, from importers, which is in the 2018 trade war, we saw that really when they imposed tariffs on washing machines, you had that effect. So that's been documented. Now, the issue with this is that this completely ignores any kind of sort of macroeconomic response above and beyond this effect on producers. In particular, tariffs tend to exert upward pressure on the dollar, which is exactly what we saw in 2018. So in 2018, while academic research finds that there was a causal impact of tariffs onto consumer prices, so they did sort of increase inflation a little bit, that was far and away offset by the fact that the dollar appreciated 8% permanently throughout 2018. So this is during the retaliation rounds. And so that we find is a massive offset to the point where it can very quickly turn what starts off as an inflationary impulse into something that would not be inflationary. In fact, I would add, if you have retaliation and the global economy slows, that would have even further deflationary pressures on the US economy in two channels. Firstly, because activity weakens because it's harder to export, there's greater uncertainty, investment spending weakens. The margins of businesses sort of narrow, and that's sort of detrimental towards activity. And in addition to that, the combination of a strong dollar and weaker global growth, particularly in China, would weigh on commodity prices, including oil prices. And so when you put all of this together, what we actually find in the report is that if you sort of simulate this kind of dynamically, so if you go through the various phases of these multiple effects, yes, initially we find inflationary pressures, but even by early 2026, the effect reverses, and you actually end up in a situation where inflation expectations, because the economy slows, end up weakening, and you end up with lower trend inflation at the end of it, so by 2027, let's say, than you would have otherwise had. And so the effect that started off as an inflationary impulse through all of these mechanisms ends up actually changing meaningfully the direction of the US economy overall in ways that I don't think most people think would be important.
So in 1930, you had the Tariff Act that came in. Global growth slowed by 66%, by 2/3. Like it was now, albeit all economies were already in a recession. Things
Exactly.
were already bad. It exacerbated the something that was already, in our countries in recession. What does it mean, if we do get 25% tariffs in Mexico and Canada, or even if it's 10 to 25%, and then you continue having something at 10% in China, and then the European Union gets a 10 to 25 as well. What could we see from a growth perspective? Could we get into major negative territory here?
Yeah. So the framework that we used, which is actually an extension to work that we had done in 2018, if you remember, when we were assessing the impact of the trade war, allows us to simulate sort of various different scenarios and the responses. The tariffs that have been announced and now postponed on Canada and Mexico raise the effective duty rate, which is basically the effective tariff rate that the US charges on all imports, from a little under 2.5% to 10%. If in addition to that, you add a universal tariff of 10%, including on the European Union, and something greater on China, along the lines of what the president had threatened during the campaign. Remember, he had said 60% on China.
Yeah.
If you do that, you're looking at an effective tariff rate that would be 20% for the US, which is, you'd have to go back actually to 1930, to the aftermath of the Smoot-Hawley Tariff Act, to look to get something similar. That kind of simulation would have very significant consequences on the global economy. For the US specifically, given that it doesn't rely as much on global trade as other countries, you would probably not look at something that would cause a deep downturn. But for smaller open economies, it would be a very sizable growth shock. So it would be very complicated for Canada and Mexico, for example, and even the European Union, a region that, its trade share of GDP, it's like 100%, for those regions to avoid a full year contraction at a minimum, and potentially looking at something considerably worse. And so it would likely alter considerably the trajectory of the growth outlook. And the last thing I'd add is, you're absolutely right. So the Smoot-Hawley experience, there's like a lot of literature on this, and it's very difficult to disentangle what the impact was of sort of the Smoot-Hawley effect directly, and the fact that you already had sort of these deflationary forces at play because of the 1929 crash, right? Yeah. But broadly speaking, the sort of that research, and again, the world economy was very different then, but still, what they usually find is that it sort of amplified the impact by about a third, right? And so you'd definitely be looking at something where global growth would grow at a minimum well below trend in this kind of environment.
Right. And so to conclude, and obviously for our clients, what's really important is investment implications here. If you look at the chart, a little bit of inflation, and then very quickly into this kind of deflationary world, I'm assuming then we've got a tilt to high quality in a situation like this.
100%. So we're actually going to be releasing a follow-up piece to this, our U.S. perspectives report. So that's our U.S. macro outlook, that will talk about what this means for the Fed response and yields. What you essentially find is that the initial inflationary impulse, because it doesn't really affect inflation expectations, doesn't really move the needle for the Fed. But what does move the needle is the subsequent slowdown. And so you end up in a situation where the Fed ends up having to cut more than it would otherwise have to do, because the unemployment rate is higher, basically, and inflationary pressures are lower. What that does is it creates it amplifies the tilt towards high quality debt, basically, because long-term yields would go down in that context and credit spreads would widen, right? And so that kind of environment would probably accelerate a view that we already have at a sort of 12-month horizon, where we're saying you should consider a gradual increase in exposure towards high quality after 2 years in which clearly treasuries and especially long duration treasuries did really poorly relative to high yield and corporate debt more generally. As the economy slows down, you should sort of consider a more gradual tilt towards treasuries, which the reality is they're trading at a very significant discount versus fair value, which is not the case for corporate debt. This would just amplify and fast track that type of effect. And so you would probably see that move occurring faster.
So if any of our clients want our report that we published on February 4th on the tariff simulations, just send us a message through LinkedIn. Also, I just want to be clear that these are simulations. We aren't sure right now. Right now, there's a 30-day pause for Canada and Mexico. It could still be 25%, like it could be zero. And so we're going to be on top of it for our clients. We'll make sure to, with any news that we get, to obviously use our magnificent quant tools to be able to simulate this. So, Joaquin, I want to thank you very much for this. This is great, and let's do this again shortly.
Sounds good. All right.
Bye.